What were you doing on October 10th, 2025 when the crypto market vaporized $300 billion in just hours? When $19.2 billion in trader positions evaporated into digital dust? When the most anticipated altcoin season in history transformed into a bloodbath of liquidations? I remember every second. The frantic Telegram messages, the charts bleeding crimson, the collective disbelief across a million screens. This wasn't just a price correction. This was financial history unfolding at warp speed. And it all started with a single social media post that would make $19.2 billion disappear in the blink of an eye. To understand the magnitude of this crash, you need to understand where we stood just hours before. The crypto world was breathing rarefied air. Bitcoin was holding strong above $120,000, fresh off its recent surge to an all-time high of $126,279 just days earlier. Ethereum was trading around $4,332, with investors confident it would challenge its $4,946 all-time high. The total crypto market cap stood at a staggering $4.23 trillion. The air was thick with anticipation. Analysts were predicting an imminent altcoin season. The stage was set. Everything pointed toward explosive growth in the altcoin market. But sometimes, the brightest lights cast the darkest shadows. Then came the announcement that would change everything. At approximately 4 p.m. Eastern Time on October 10th, former President Donald Trump posted on Truth Social about China's extraordinarily aggressive position on trade. He announced that, starting November 1st, 2025, the United States would impose a 100% tariff on China over and above any tariff that they are currently paying. The market's reaction was instantaneous and violent. Bitcoin fell $3,000 immediately as the post went live. What began as a tremor quickly escalated into a full-blown financial earthquake. Within hours, Bitcoin cratered over 12% to plunge below $110,000. Ethereum tanked 16% to below $3,700. Major altcoins like Solana and XRP crashed 20 to 30%. Some smaller tokens saw devastating drops of up to 70%. The numbers became almost incomprehensible. $7 billion in liquidations initially reported, then revised upward as the carnage continued. By the time the dust began to settle, final tally would reach that mind-numbing figure, $19.2 billion in total liquidations. The crypto market had shed $300 billion in value in mere hours. Behind every liquidated position was a human story. Across social media, the trauma unfolded in real time. Prominent trader Bob Lacus called it COVID-level nukes, adding, "Wow, nasty, nasty action." But also a great candidate for the mother of all shakeouts. Well-followed trader Pentoshi captured the collective pain. "I know there are a lot of emotions right now, and this flush is in the top 3 all-time. There are a lot of people in incredible pain right now, myself included in that." Ram Alawelia, founder of investment firm Lumida Wealth, provided analytical context. The Trump news combined with overbought conditions led to a sharp decline. But perhaps the most chilling assessment came from Zahir Ibn of Split Capital. The altcoin complex got absolutely eviscerated. We're at levels not seen in more than a year with regard to altcoins. Full leverage reset and market dislocation. Crypto crashes aren't new. We've lived through booms and busts before. But October 10th wasn't just another downturn. It was structurally different in ways that magnified the damage. First, the market was swimming in leverage, according to Derive Size Research. Implied volatilities across 14, 30, and 90-day expiries had surged to their highest levels in 30 days, just before the crash. There was a dense band of short positions, at risk of liquidation, just above the $121,600 level. When the trigger came, it wasn't just prices falling, it was a domino effect of margin calls. Second, this was the first major crash of the institutional era. While previous crashes were predominantly retail-driven, this time institutional money was deeply embedded via Bitcoin and Ethereum ETFs. The US BTC spot ETFs had seen $62.77 billion in total inflows, meaning traditional finance was directly exposed in ways never seen before. Third, and perhaps most importantly, the market was psychologically primed for growth, not contraction. Everyone was positioned for an altcoin season. The narrative was capital rotation into risk, not away from it. When the reverse happened, the whipsaw effect was catastrophic. The mechanics of destruction. Let's break down exactly how $19.2 billion in value can disappear so quickly. Not magic, it's mathematics, meeting margin calls. Imagine you have $10,000 and use 10x leverage to open a $100,000 position. If the price moves 10% against you, your entire collateral is wiped out. Now multiply this by thousands of traders across hundreds of exchanges with varying degrees of leverage. The liquidation process became self-reinforcing. 1. Initial. Selling pressure from the news triggered margin calls on leveraged long positions. 2. These forced liquidations created additional selling pressure. 3. Which triggered more margin calls, creating a negative feedback loop. 4. With each wave, the selling intensified and spread to more assets. The altcoin market, being less liquid than Bitcoin, suffered disproportionately. Zahir Ebtekar noted, the altcoin complex got absolutely eviscerated. Full leverage reset and market dislocation. This was unjust a correction. It was a systemic flushing of leverage from the entire crypto ecosystem. While crypto bore the brunt, traditional markets didn't escape unscathed. The S&P 500 had already pulled back 0.28% on October 9th. With the Nasdaq 100 decreasing by 0.15% and the Dow Jones Industrial Average falling by 0.52%, the crypto crash amplified existing anxieties in traditional markets. Meanwhile, as crypto bled, gold surged to a fresh all-time high, testing the $3,915 resistance area as investors sought safety. The classic flight to safety was underway. This interconnected reaction demonstrated something crucial. Crypto is no longer isolated. What happens in digital assets now reverberates through traditional finance and vice versa. The walled garden has been breached. So where do we go from here? The charts are still bleeding, the liquidations are still processing, and a community is licking its wounds. History tells us that markets eventually recover. After March 2020 came an unprecedented bull run. After the Mt. Gox collapse came renewed infrastructure building. Crypto has a habit of emerging from crises stronger and more resilient. But something has fundamentally shifted. The narrative of decoupling from traditional finance lies in tatters. The promise of digital gold must be re-examined. The institutional embrace now looks more like a double-edged sword. The October 10th crash will be studied for years. The triggers, the mechanisms, the human psychology. But beyond the analysis lies a simpler truth. We witnessed financial history's acceleration. What typically unfolds over weeks or months was compressed into hours. The question isn't whether such events will happen again. They will. The question is whether we'll be better prepared. Whether we'll respect leverage, diversify beyond crypto, understand that in our interconnected world, a trade war tariff can vaporize $19.2 billion in the time it takes to read a social media post. If you remember nothing else from today, remember this. The market doesn't care about your expectations, doesn't care about your leverage, doesn't care about your altcoin season predictions. Risk management isn't sexy until it's all that saves you. Drop A if you're surviving this crazy day with us. Stay safe out there.